Backed by popular demand after quite some time, we are going back to investing basics, which is the broad market S&P 500 exchange traded funds or ETFs. I just wanted to give a quick shout out to my viewers for watching my first ETF video that I made back when my channel was less than a month old. That video has since gone viral and garnered over 110,000 views, so thank you. Today's video is also intended to be an introductory explanation into 3 of my favorite S&P 500 ETFs for those looking to get started in the stock market. Believe it or not, a vast majority of retail individual investors want to be invested in the stock market, yet do not want to get into the nitty-gritty details of stock analysis and stock picking. Thanks to ETFs, investors can gain broad exposure to the indices with minimized risk while realizing capital share appreciation and dividend income. Hey guys, this is Nick with Nick Does DGI, and welcome back to my channel. In this video, I'll be going over 3 S&P 500 ETFs to buy and hold for investors of any experience level. I hope you find some value out of this video, and if you would like to support this channel, I appreciate you clicking that like button and subscribe button. Let's get into it. Before we dive into the 3 selections, let's quickly go over what an ETF is. Exchange traded funds or ETFs are essentially an investment fund publicly traded on the stock market. Think of it as a basket of stocks, bonds, or commodities that you can buy and sell with your investment brokerage. ETFs can be actively managed or passively managed by tracking an underlying stock market index, small or large. The only drawback, however, is that most ETFs do charge a small type of annual fee called the expense ratio, which can vary as little as 0.03% to over 1% annually. For purposes of this video, we'll be exploring ETFs that track the S&P 500 index. S&P 500 stands for Standard & Poor's 500, which simply tracks about 500 large companies listed on stock market exchanges in the United States. The S&P 500 includes companies across 11 sectors and is intended to depict the health of the country's stock market and broader economy. So when you turn on the business channel, you will almost always see the S&P 500 index tracked alongside with the Dow Jones Industrial Average, which is another stock market index of 30 companies, as well as a NASDAQ composite. It's important to keep in mind that just because there are multiple S&P 500 ETF providers, that you don't have to feel compelled to invest in more than one. In theory, a single S&P 500 ETF will give you the same exposure to the broad stock market. Take this video for what you will as a starting point for doing your research and due diligence. The first S&P 500 on the list is the Vanguard S&P 500 ETF, ticker symbol VOO. This ETF invests in the S&P 500 index, representing 500 of the largest US companies while offering high potential for investment growth, and is more appropriate for long-term goals where your money's growth is essential. VOO has an annual expense ratio of just 0.03%. This means that for every $100 invested into VOO, 3 cents will be subtracted from the ETF's performance each year. In the grand scheme of things, this is a very small price to pay for such an automated passive investing approach. VOO currently trades for around $407 with a dividend yield of 1.3%. The average dividend payout is $5.29 with a 5-year dividend growth rate of 5.72%. This dividend is paid quarterly every March, July, October, and December. The fund's total net assets is by far the largest out of the 3 at $753.5 billion, and its 10 largest holdings make up 28.5% of the fund. The second S&P 500 ETF on this list is the iShares Core S&P 500 ETF, ticker symbol IVV. So why IVV? This fund gains exposure to large, established US companies while maintaining a low-cost, tax-efficient access to 500 of the largest cap US stocks. IVV also has an annual expense ratio of just 0.03%. IVV currently trades for around $444 with a dividend yield of 1.27%. The annual dividend payout is $5.65 with a 5-year dividend growth rate of 5.21%. This dividend is paid out quarterly every March, June, September, and December. The fund's total net assets come in at $297.7 billion, and its 10 largest holdings make up 27.8% of the fund. The third S&P 500 ETF on this list is the State Street SPDR S&P 500 ETF Trust, ticker symbol SPY. SPY seeks to provide investment results that, before expenses, correspond to the price and yield performance of the S&P 500. Unlike VOO and IVV, SPY has a higher annual expense ratio at 0.0945%. SPY currently trades around $442.73 with a dividend yield of 1.26%. The annual dividend payout is $5.57 with a 5-year dividend growth rate of 4.97%. And this dividend is paid quarterly every April, July, October, and January. The fund's asset under management is $384.6 billion, and its 10 largest holdings make up 27.85% of the fund. I know I threw a whole bunch of information and data at you, so thank you for being patient with me. I put together this side-by-side comparison for your viewing. I'll give you a few seconds to take a picture or pause the video to get a full look. As you can see, these three ETFs are virtually the same with negligible differences. The only thing that really pops out to me is the higher expense ratio with SPY, but even then, I'm not exactly sure how much of a difference that'll make in the long term. And if you're wondering why I didn't go over the top 10 individual holdings within each ETF, take a look at this side-by-side comparison. Apple, Microsoft, and Amazon dominate the top 3 holdings, and other large cap companies like Google, Facebook, Berkshire Hathaway, Tesla, Nvidia, and JP Morgan are also heavily prevalent among the ETFs. If I were to cross off the labels and show a random person this list, he or she would probably assume that these ETFs would perform just about the same, right? But to be sure, I backtested the past 10-year performance of these 3 ETFs with an initial $10,000 investment going back to the beginning of 2011. As expected, there is virtually no difference in portfolio growth from the naked eye. If you want to see the specific breakdown, you can see that VOO in blue returned $43,095, IVV in red returned $43,059, and SPY in orange returned $42,856. With the so-called democratization of finance, these ETFs are available for free on essentially every investment brokerage. For example, you no longer have to be on the Vanguard platform to own VOO. With my investing platform of choice being M1 Finance, which I will include a referral link in the description below, I can find these 3 ETFs on the platform and add them to my portfolio in a matter of a few clicks. The takeaway of this video is that there are legitimate low-cost S&P 500 ETFs out there if you are a type of investor that simply wants to track the stock market index and does not want to undergo hours and hours of tedious stock market analysis. For the masses, investing is still a very convoluted and scary topic. All too often I have heard from family and friends that they want to start investing, but are often overcome with fear with analysis by paralysis. So they end up sitting on the sidelines as the market continues to go up and up. If you are a newer investor looking to get started, or even if you have been investing for some time, I hope my channel can provide some insight and clarity for your investing journey. Please note that this video is not intended as financial advice, nor am I a financial advisor. Past performance is no guarantee of future results, and please take the information with a grain of salt. Please do your own research and due diligence when deciding to invest in investable securities. If you found this video helpful, please consider clicking the like button and subscribing to my channel. Hit the bell notification to receive an alert on all the latest videos. The YouTube algorithm likes these sorts of engagements and helps my channel get shown on more homepages. Until next time, take care.